The one thing I hate about you, man. Let me see. This is hard. How I say this sounds true, but not too offensive. You know?
Dude, go at it, man. I'm not easily offended. You know me.
Ever found yourself wondering whether it's time to get a lawyer involved, or are you going through a merger or acquisition and want to know what to expect from the lawyer you have? Well, you're in luck because Avetis sat down with one of tech's top startup and corporate M&A lawyers, Hayk Mamajanyan. Hayk has all the accolades you can think of, studied at Oxford, UCLA Law, American University of Armenia, and was the founder and managing attorney at HVM Law for over a decade. Let's dive into the episode.
So, Hayk, I want to start with your very cool story. You know, you and I have known each other for a while, but the other day I was blessed enough to just kind of unwind with you at our very close friend Osped's house over a nice fire. And you got a cool story, man. Like, tell me a little bit about kind of your upbringings and where you started and your education. I thought was very interesting, going from Yerevan to Oxford and all that. So tell me your story, brother, and how you got into this world and why you stay in this world.
Thanks, man. Appreciate it. You know, that's a good question, because I remember myself sitting in the law library and reading this book about law and economics, and essentially was explaining how you can use economic concepts to draft enforceable contracts. And it wasn't talking about law that much. It was just speaking about the underlying economics of any transaction, right? It's about risk allocation. It's about symmetries of information. It's about alignment of incentives of the parties. And it was talking about how you can address these things in a contract, and how by doing that, you can make sure it's enforceable, and it also makes both parties happy. And as long as you do that, you can become a good resource for entrepreneurs. And that was very appealing to me, because I understood these underlying economic concepts and I wanted to help entrepreneurs. And that's pretty much when I decided I wanted to focus on corporate law and business law. And since then, it was just a lot of fun learning and growing and helping folks close deals and going from there.
How old were you when you invented or came up with this amazing passion of yours?
Yeah, that was 12, 13 years ago. So I was probably 23, 24 years old.
Okay.
Yeah, it's been over 10 years now.
I'm going to force you to not be so damn humble. Tell me about your education and how you went about that.
So I started in Yerevan, Armenia, at a local law school. And then I went to American University of Armenia in Yerevan too. And that was pretty interesting too, because I had a good job and I had a good career, but I didn't want to settle for just a good job, a good career. I wanted to do something special. I wanted to have a purpose, right, in my career too. And I think me shifting towards American University of Armenia and getting education there helped me a lot to not just gain knowledge, but also, just understand critical thinking, intellectual honesty, and creativity, and making your own financial decisions a little better. And also just, meeting my mentors and good friends and colleagues to this day. So that helped a lot. And then from then on, I went to England. I studied law, corporate law and finance in Oxford University. And that was a fantastic experience with the professors, the students, everyone was brilliant. Then I moved to LA and did the same thing in UCLA, actually. And that was absolutely humbling too, just, meeting all these amazing people. And from then on, continued working in this space and with a few firms until I opened my own practice, HVM Law, right? And that's when we actually met. And that was great, because I was working with investors and entrepreneurs and helping them to close deals and trying to be more of a strategic partner for them rather than just a passive attorney, and trying to add value by helping them close deals and make deals and come up with new ways of doing business.
That's awesome, man. What's the key difference you noticed between the three universities you attended, the three main ones?
Yeah, that's a good question. I think, this is funny, but the key difference was that I was different in each and every one of them, right?
You were different?
I was different, because I think all of them were great, and all of them were pretty academically, excellent, but also practically great. in terms of teaching you the practical skills and helping you to understand how the practice of law works, right? It was just, I was different and I had different experiences, but they all, helped me to become who I am now. And I'm very appreciative for this journey.
Amazing. Amazing. Good for you, man.
Thanks.
Young guy, you've done a lot for the years you've been in the business. So, and someone I actually count on when I'm trying to make a decision on a company and I don't have the time to do the due diligence that I need to. You know how I kind of roll, right? I make decisions on the fly, sometimes too much so, but that's who I am, right?
Absolutely.
So Hayk, tell me a little bit about your world, right? You're in the legal world. What do you think is the key to successful merger acquisition in the tech industry? And how do you ensure that your clients are protected through the entire process?
This is a complex issue because in my practice, I realized that it's not so much the attorney that ensures the success, but the actual parties, right? The buyer and the seller. If there is trust, if there is good synergy, then you can tell that it's going to be a good transaction, an easy transaction. And if there isn't trust or synergy, or people are not on the same page about the terms, about the economic understandings of the deal, then most likely the deal is not going to close, even though as an attorney, you can do everything the way it's supposed to be done. But essentially, first should be the understanding of the economic terms. Why are these parties entering into this transaction in the first place, right? If you represent the buyer, why is the buyer interested in buying this company, right? Are they going after the assets, the intellectual property, the employees, the team, right? Or the customers, or maybe the licenses, the permits that the company has. So it's truly important to understand why they want to close this transaction. But also, you want to know what's driving them in terms of they're trying to grow. Is it a growth acquisition, or is it they're trying to close a gap in their own organization? And the same is true about sellers. When you represent the seller, you need to understand what is their purpose, right? What is their goal in this transaction? Are they going to continue with the new company? They're going to become a part of their company and continue growing with them? Are they exiting, right? Maybe they just want to exit. They want to do something else. They want to take a year off and then start a venture capital fund or something else, a new startup. So understanding all these basic details is super important to be on the same page with the parties. But then, of course, from legal point of view, you have to know the company really well. So you have to be involved from day one, and simple questions such as, who are the shareholders of the company, right? When you're the seller, you need to know who are the people on your cap table, how are you going to allocate the proceeds of the sale among the group. Then you also have to know who are the decision makers, right? It's a sale of the company. Who you should go to get their approval to be able to sell the company. You need to know who the board is, what are the rights of the board members. Maybe someone has a veto right, to veto the transaction. So you need to be aware of all these things too. You need to understand your assets, right? They're protected, your intellectual property, you have trademarks, you have patents registered, You need to understand your licenses, permits, also your employee relationships, any disputes, right? Maybe you have a dispute that's going to be a huge blocker for this transaction. So doing your own due diligence, right, and sell your own company as a seller before going out there is huge to make sure you know what you're getting into. And the same is true about the buyer, right? As a buyer, you hire an attorney to do a due diligence, legal due diligence, to understand all these issues, to ask the right questions, to get the information, to review the information, to advise you on the legal complexities and risks of the transaction. And this is just the first step, right? Because then you're going to focus on the structure of the transaction. Is it an asset sale, a stock sale, a merger? And for that, you need to have due diligence, understand the risks to be able to give accurate advice to your client. The purchase price, right? Are you paying in cash or securities or a combination of both? Is there a loan component of that the seller is financing the deal? Or maybe there are earnouts, price adjustment mechanisms, all these different, complex components of a transaction. Then, you can focus on things like indemnification and the promises that the parties make to each other, and then the restrictions, right? Non-competition clauses, non-solicitation clauses. And even though this may sound very legalistic to you, right? It's all legal terms that don't make a lot of sense to a lot of people. Again, you got to think about these things from an economic point of view, right? You have to ask questions. You have to listen carefully to understand the need of a client to be able to give these legal solutions. Legal solutions do not come first. The economics comes first. And once you understand that, then you can give the right legal solutions. And of course, I mean, you have to make your client's life easier, right? You got to prepare term sheets. You got to prepare checklists to, like, you know, show everything in a very concise manner to the client, because they're busy people, right? If you sell your company or you buy a company, you're not going to put everything away, your life, your business, and just focus on this. You're going to continue with your customers, with your life, but then also you want someone to help you to understand how this is done. And that's why, you know, you sign LOIs, you have term sheets, you have checklists to kind of go over things in an easy way. And again, you got to be scientific in your process, right? You can't
Hayk,
be just...
sorry to interrupt, are you more on the seller side or buyer side typically?
You know, I did more seller side transactions, but I've worked with buyers too in the past. So that's a very good question, because it's very important to understand both sides of the playbook, because they pretty much want the same thing, right? They come from different perspectives, but as long as you understand both perspectives, you can help the parties to come together versus, you know, make the gap even bigger. So I work with both, more sell side, but understanding the playbook of the other side is super important. So that's a great question. So being scientific and understanding your own limitations too, right? I need a team. It cannot be just Hayk, right? It has to be Hayk with his associates or paralegals. If needed, you got to bring on an employment attorney, a tax attorney, an IP attorney, because those are complex issues. You can't just rely on yourself. At the end of the day, the most important thing, you got to close the deal, right? If you do everything right, but you don't close the deal, then the client is most likely not going to be happy. So people care about the process a lot, but people care about the result, the outcome even more. So make sure you have the right approach, the right process, but also you achieve the outcome that the client wants. And if you do that, they're going to love you and they're going to come back to you with more interesting matters.
Hayk, thank you. That was great. I've had a lot of friends that have exited. I've also attempted to exit that didn't get there. They told me that after the LOI, it's one of the most difficult times of their lives, right? That 1 year period of time, they're poking at you at every angle. And sometimes the LOI is done with not full intentions to purchase the company. What's something somebody should look out for and prepare for if they're getting ready to sell their company? Because I know it's not like selling a house where you put it up for sale and it's gone within 40 days.
Yeah, no, absolutely. Now look, those are really good strategic questions, right? And it really depends on the circumstances of the company, right? The business itself. You probably don't want to go out there and market too much to sell your company, because probably ideal situation is when a buyer comes to you and they're like, oh, you know, maybe it's your customer, right? You work with a big corporation, a big customer, they do deals with you, they work with you, they like the team, they like you as a person and as a professional, and they're like, oh, you know, we need these guys. If we have them in-house, we can get so much done. They will add tons of value. So if that's the case, then that's a completely different situation. Sometimes it could be a shareholder dispute, right? Imagine a situation you have a co-founder or two co-founders, and then there's an issue between you guys and no one sees a future in this company. So that's how you want to sell. And in that case, you will have less leverage in terms of how to negotiate and what to do. So it really depends on the underlying facts of around the transaction. But generally speaking, just make sure you understand your company, you know your company very well, you have records, you have agreements signed, everything is registered, everything. You talk to your attorneys, your accountants on a regular basis. And look, I'm saying these things as if working with an attorney is easy or inexpensive, which is not the case, right? It can be hard, the language we speak is completely different, and our fees can be extremely high too sometimes. So I think that's the main challenge. If you ask me as an attorney, what I see a lot, it's not so much the actual legal or business issues. It's more like the communication within the client and the attorney, and also the cost, right? Cost of being able to afford an attorney. And I think we as attorneys, our profession needs to change a little bit, where we should be more mindful of the finances of our clients, because I don't think it makes a lot of sense to pay $1,000 or like $800 for a first-year associate, right? They don't know much. They're super brilliant, they're talented, but they don't have a lot of experience. So basically you're paying for them to gain experience, learn on their own mistakes, which is gonna cost you a lot of money. So it's key to find a good attorney, but it's not super expensive, unreasonably expensive, and that understands you, can communicate effectively with you, and understand your business and is available, right? I'm talking to my neighbor. He sold his company and he's telling me he is scared to call his attorney because every time he calls them, they get like these huge bills with like, details of how they now have to pay these fees. And I think that's the key to create the synergy with your client when they're not scared to reach out to you and you're just mindful of their finances and try to ease the burden on their end as well.
Hayk, we used to laugh about this every time we would call our attorney. My business partner and I are, we're friendly people. So he would start asking questions about, hey, how was your daughter's wedding and this stuff like that. We realized they were invoicing her for this. So I told Jeff, stop asking questions about how their daughter's wedding is. We care, but we really don't care enough to get charged for it. So we had a good laugh about that with the attorney. We're like, hey, are we being charged for this? If so, let's kill it. Let's kill the niceties. Hayk, a question for you. The questioner / comment. You talked about cost.
Yeah.
To me, it's never about the cost, it's about the value. It's funny you brought this up because one of the things that I've been told by my buddies who try to do it on their own, that it was one of the biggest mistakes that they've ever made, including the ones that were actually had successful exits. They said it drained them of everything they had. And looking back, that they wish they had hired an attorney and spent a few $100,000, whatever. That's all easy to say, but I want to know, if I want to exit, how does a company pay? Is it an hourly rate? Is it a transaction fee at the end? Like our listeners who are a couple years away, what does that look like for them? What should they expect?
That's a great question. And look, I'm flexible, right? I'm flexible. I'm trying to make sure the client gets the help they need. And I can do hourly, I can do flat fee. The thing with exits, M&A deals, it's hard to know the exact scope of the transaction, right? Because you do flat fees when you know the scope. You have done it in the past a few times. You talk to the client, you say, this is what you need, 10 things, boom, this is how much it's going to cost you. Client is happy because they control the process. They can be like, no, I don't need 10 things. I need 8 things or 12 things. And based on that, you change the price and send it back to them. They control the process. They tell you what they need, what they don't need. You talk to them, of course, you advise them about, maybe you want to still include this thing. But then they greenlight the price and then you move forward with the process. With M&A deals, frankly, it's hard to do so because you don't know which direction it's going to go. If you issue stock options, right, to your employees, you tell me it's 10 employees. I ask you about the terms. We discuss the terms. We put together the plan, the consent, and all that stuff. And then I know exactly how much time I'm going to spend. And I know I want to be nice to you. I'm going to give you a discount. This is your fee. You're happy. Everyone's happy. You paid. We do it. And because we know the scope. But with M&A deals, it's a little harder because, again, you just don't know how much time you're going to spend. And it's really hard to take the risk by saying, okay, it's going to cost you $50K. When in reality, you may end up spending twice the time that you expected when you were given that flat fee.
Got it.
So M&A is a little harder because it's very unique. You'll be surprised. Every single M&A is so different. That's awesome, right? Because you see different things. You help people with different things. You grow. But at the same time, it's just so different based on the actual facts.
Yep.
On the ground, also the legal complexities that each company and parties have in a particular transaction.
Hayk, what are some common mistakes you've seen tech startups make when it comes to legal compliance, and how can they avoid these pitfalls?
Yeah, there are a lot of them, right? There are a lot of different mistakes that are being made.
Give me the top 3.
Oh man, there's so many. There are so many. And the funny thing is that you can always avoid them by reaching out to a lawyer, right? If you reach out to an attorney, if you talk to someone, right? You don't even have to pay them for that. Just reach out to someone. I know you do this. Can we talk for 30 minutes? I have questions, right? Then 30 minutes becomes an hour, and they probably not going to charge you. Or at least you can ask, is this free? Is this, what's the rate? In my case, I always talk to folks a few times, do my own due diligence, invest my own time to understand the business, the parties, to see if I can communicate with them efficiently, right? If it's someone I can communicate with, why would I charge them? Why would I spend my time and their time into trying to build something?
Sure.
And every single one of these mistakes can be, avoided by talking to an attorney. But I think the biggest thing for me is not having the right entity, which is such a simple thing, right? You talk to any attorney who's been doing this for a couple of years, they will tell you exactly when you need to have an LLC, when an S Corp, and a C Corp. They'll talk to you for 10 minutes, understand the business, and then tell you their recommendation.
Is there any general suggestions around that? Because we were a C Corp, we became an S Corp. No intention to exit. It's just something we decided to do for other reasons. What are your thoughts on that?
So look, as a tech company, you got to be a C Corp. You got to be a C Corp because that's what the investors want. And investors want that for multiple reasons, but also including for tax reasons, right? There is this huge exemption, tax exemption, qualified small business stock, and that applies only to C Corps. So essentially you sell the company, and as you sell the company, the first $10 million is tax-free, right? And that applies to you as a founder, to advisors, to employees, to investors, right? So if I'm an investor or an employee or a founder, I want a C Corp because I want to make sure I benefit from up to $10 million tax-free benefit. And also, it makes it easier to incentivize your team because as a startup, you cannot be just 1, 2, or 3 people and become a successful company. You have to scale up your operations. You need a team. And many startups don't have a lot of money early on, so they need to incentivize them by equity, right? Sweat equity.
Yes.
And the way you do it, you issue stock options, you issue restricted stock, and they earn it on the vesting schedule. They earn it as they work, they earn it. And C Corps have very clear guidance in terms of how this works. Not so much S Corps and LLCs. So because of these very simple economic reasons, again, these are not legal, these are economic reasons. You want money, you want to incentivize, right? You want to make sure you benefit from all these things. Because of the economic reasons underlying problems, you choose to be a C Corp. That's not the case with funds. I work with venture capital funds, and they're always an LP, limited partnership, or an LLC for different reasons, right? Pass-through entities, they want to make sure that it's not too complex, and there are certain other legal benefits too. So really, depending on the actual business and the details of the business, by asking 5 questions, an attorney can narrow it down to like a few options, and then by asking extra 5 questions, they can narrow it down to one question, to one type of entity. So it's really about communicating and going back and forth and understanding what the founders are looking for and then helping them with that. So look, the other one would be intellectual property. You got to have IP assignment agreements in place. You got to have confidentiality agreements in place. You got to...
With employees, with partners?
With employees, with partners, with every single person that does work for your company. Because startups, tech startups, they create intellectual property. That's their main value. And you want to make sure when an investor comes to you, you can prove that everything is owned by you by showing just a list of people that signed the IP assignment. Everything that they developed belongs to the company. Not to you as a founder, yes, but to the company.
And if for some reason that is not the case, that is going to it's going to destroy most of these deals, right? There's no entry.
So that's going to be a major risk. That's going to be a major risk. As an investor, I would be like, go ahead and sign these contracts with everyone you work with. Come back to me, show me the IP assignment agreements, I'll be happy. Because this is, of course, as an investor, you buy maybe like 0.1% of the company, 1% of the company. But the 90% is still owned by the founders. The founders should worry about this much more than us as investors or us as attorneys. So it's a good advice for them to do that. And trademarks, patents, if you don't do them on time, it can become an issue. Many times it has become an issue, and you want to address it early on and move to more important things like operations and profitability and product market fit and stuff like that.
Hayk, thank you. That was very, very helpful, I'm sure, for folks trying to take that journey in the next few years. As an attorney who knows startups very well and M&As and all that, what do you look for in startups, especially early stage startups, to kind of determine their likelihood of success?
Yeah.
And how do you actually evaluate its potential for success? Because early on, it's really a crapshoot. We all know that. But I'd like to kind of change that a little bit for myself, at least. So how do you determine if there's potential for success and if there's anything behind the Komodo?
No, absolutely. Look, it's hard to determine that, right? It's almost impossible to do that. So it's just a bunch of assumptions. You're trying to find patterns and stuff like that. And it has to be the team, right? If you think about it. If it's a team that they maybe have done this in the past, then it becomes a safer bet, right? It's still a bet, but it's safer because you know that you trust them, you know they have done this in the past.
Track record, basically. You're looking for 100%. A track record of success.
Absolutely. Track record of success. They've done this in the past. They know how to do this, and that gives you more comfort to put your money and your time into this venture. Then, of course, the product, right? If someone comes to me with a legal tech product that I understand very well, I look into it, I'm like, oh, I had this problem, and many attorneys like me have this problem, then again, that helps a lot because you understand the product, the potential, how it can be, shifted in a few different ways to make it a success. Again, some assumptions, but nothing's guaranteed, but that helps a lot when you understand the product. Not always the case, and that's why we're part of different angel groups where you have people with domain expertise that tell you that this is something that the market has a need for, right? And that helps a lot as well. And the market, of course, you want to have a market that is big enough. The geography, when they're focusing on, is good enough for you to understand and for them to make money. And of course, traction, right? A lot of these early stage startups have zero traction, but traction doesn't necessarily mean that they make money. Traction can mean anything, right? It could be how well they're dealing with putting together the right team, how well they're closing their first investors, how well they're communicating with the stakeholders. All these things really matter because, as you know, success is not just how smart you are, it's how you execute, right? How you do things, how you're consistently succeeding in these small tasks that becomes this huge success and at the end of the day. And just, based on what I'm seeing these days, the uncertainty in the market and lack of good projects, right? People say that a lot. I would say that nowadays for 2023, 24, 25 moving forward, I think my focus is going to be a lot on the potential of becoming profitable early on, right? Because you want to make sure that the company stands a chance to become profitable. Because nowadays you see a lot of companies, startups that raise a lot of money and with the promise of profitability or product market fit, but they don't have it. So profitability, product market fit, basically when and how you're going to reach a point when you have a lot of customers that want your product and you don't have enough resources to provide that, right? Sure. And as you reach that, then you can securely raise funding because now by using this money, you can achieve that and then you can achieve profitability. So those are the important questions to ask this year, next year, and probably moving forward. Those are good scientific, basis for investing. Even though in early stages there's not much science, it's just you believing in someone but it would help to have a little more scientific, methodical thinking even early on and ask the questions to see how the founders see these processes evolving in the future.
That's great. Yeah. So you've often heard me probably talk about talent is overrated and execution is everything, right? Obviously, talent is important, but to a certain point, it really comes down to execution. In fact, most of the startups that I've seen, the product is phenomenal. And it's just they can't execute on basic things like sales. People forget.
Very true.
It could be a brilliant product. If no one buys it, it's worthless, right? It could be, frankly, an average product that you can improve upon, but you've got the folks buying it. I think you can make a lot of improvements with some money. I had a question for you. You talked about profitability, right? And usually these pre-seed, seed startups, I don't even know if they even think about that, right? Because they've been watching the Amazons of the world, lose money for 10 years and then turn it around and become one of the most valuable companies. How do you determine that, right? Because if you turn your focus too quickly to profit, right, then you have a lifestyle business sometimes, and you're just not pouring enough gas on the fire. But to your point, I've got to see that you've got a product that sells and you've got your operational costs under control. Otherwise, you'll never make it profitable. What's your advice on that? Both investors and for startups that want to get investors to take them serious.
That's a great question because it's a trade-off, right? Just like everything else in life, you got to see both perspectives. Of course, you want to scale the company. You don't want to focus on profitability too early on. You want to build the company, build the customer base, make sure you have the right product for the customers. But at the same time, it's also ridiculous to raise like hundreds of millions of dollars and not even be remotely profitable, right? Because as entrepreneurs, like, in any business, if your only way to survive is to raise funding, and I know you want to talk about down rounds, right?
Get to that.
Right? If that's the only avenue for you to continue existing, to continue growing, you're going to end up, having issues with your
It's like a
co-founders.
Ponzi scheme, Hayk, right? If you keep raising money, it's eventually a Ponzi scheme. We got to turn some of these over.
Yeah, and then you like at some point as an investor, you should think that if the founders get diluted too much, they're not going to be incentivized enough to make this a success. Of course, that's the first thing you think about as a founder, your own, economic bottom line. But as an investor too, you don't want to put them in a position when they don't think it's worth it on their time to do all these things because you were not nice to them when it was a time to help them, and now they end up with like 5% of their company, and now you're selling it for 100 million, they get only 5 million, right? So all these things are super important, and this becomes more psychological than legal or business, how you make sure you don't affect the morale of the company itself, right? If you're profitable, it gives you more leverage to raise funding now, or maybe in the future, or maybe do a bridge round. If you're not profitable, to be honest, again, the only way to survive, not even to succeed, to survive, is to raise funding. And that's when you end up in situations when you have to raise a down round and you raise all these questions inside your team and then inside the bigger stakeholder group with investors and advisors that, how come things are not working out the way they were supposed to?
Hayk, let's talk about 2023 and the challenges that deal making in tech is facing right now, whether they're raising their next round or they are looking to acquire or they're looking to get acquired. What are the biggest challenges in this economic scenario?
It's the uncertainty, right? We hear a lot these days that there is a lot of money out there, a lot of capital that's sitting on the sidelines and waiting for the right opportunities to invest or to acquire. And that is probably true because I talk to a lot of investors, family offices, and institutional investors, and all of them are telling us that they have the capital, but they're very cautious, careful in terms of closing deals. They take longer times to talk to founders, look into the companies, and do due diligence. They're ready to invest, but they're not ready to invest as fast as they did in the past 3 to 4 years, right? And I think that's an indication of a healthy market.
Yes.
Right? We're too used to this past 3-4 years when things were happening too fast, erratically, right? I'm not saying we should forget that because we, learned a lot of lessons from that. But at the same time, we should just focus on what's going on now. And if you look at the Q1 2023 numbers, sometimes they're confusing because you see like all these different, data that is inconsistent. And that's when you realize that even you're trying to make some conclusions for yourself, it's still pretty uncertain what's going to happen in the next couple of quarters. So I truly think that Q2 and Q3 are extremely important in terms of how the deals will shift the deal making, because apparently the down rounds went up. Right now it's 15 to 20%. Usually it's up to 5% of all rounds are down rounds. It's 15 to 20%, which is a huge hike. But on the other end, it looks like, based on some sources, that M&A deal making in tech increased, which also makes sense. If you can't raise, you're going to either sell or try to do a bridge round or a down round or try to become profitable, right? Those are your main options. And M&A is one of them. So M&A is on the rise, at least in tech. Based on some resources, again, it's hard to know. And then down rounds are up and bridge rounds are up too. There are more bridge rounds. And all these things are a little unusual if you started your career in the past 2 years, right? In the past 2 years, things were like, rounds going crazy valuations, huge checks, everyone's happy, everyone's throwing parties. Not anymore, which again, if you ask me, is an indication of a healthier market, a healthier mindset among investors and the founder community to get things done the right way and then raise funding.
I feel like this goes back to the same thing. It's all about balance, right? If people are not cynical at all, they're just throwing money at things just because their friend said so, or this is the next thing you want to be a part of. It's FOMO, right? I don't want to miss out. I don't want to lose. Same thing goes with hiring. Anytime we've hired too quickly and rushed it, and we knew those people weren't the best, but we needed hands, right? We needed hands. So what you do is you look up and say, we knew and still made the wrong decision. So I think, so you're saying there's some healthy pessimism. People are a little more cynical. They're more likely to vet things out before they go blindly invest. And I think it's creating a bottleneck. I've noticed in some of the angel groups we're part of, it's been tricky to close even small deals, which is, it's got to kill morale for the startups because they can't even raise 50, 100, 200 grand to get off the ground. It must be frustrating. Any advice you have for them?
That's very true, and I feel like this is just the paradigm shift from decision making based on hype on the investor side towards decision making based on some scientific proof that this can be successful. And I use the term scientific very loosely here because, again, it's hard to find any scientific proof in early stage startups, right? Science really and methodical decision making really starts at Series B, Series C when you can show some projections, sales and growth. Pre-seed, forget about it, right? So my suggestion and advice to pre-seed stage founders would be just focus on the people that know you, right? Good old family and friends round, maybe some fools you can throw into that too, but family and friends, just go to people that you trust and just go the extra mile to show to your investors that this is worth their time and then their money. Because this full well that we spend like hours on end researching, analyzing, doing due diligence on these different companies. And if the founders are not helping with that, that's a huge red flag on, or early on. So make sure you focus on people make sure you focus on the low-hanging fruit, basically, and just be scientific as much as you can in your process. Learn from your mistakes very fast. Try to find a lead that is well-known. And of course, it's not easy to achieve, but if you are able to successfully achieve these things, small steps, then you will increase your chances of raising a pre-seed or seed round.
Nice. I typically invest in startups that have really, really sharp, really focused founders. From history, what have you seen? What type of founder, not personality type, functionally have done best? Meaning, let's assume they're all tech companies. Do you like tech companies led by tech folks or folks with the sales mindset? I'm mixed, right? I know you need a brilliant technologist to have a great product, but I often see those same people struggle to get customers because they don't have a sales mindset. There's a saying in sales, and raising funding is really sales, if you really think about it, that you sell the way that you're sold to, or prefer to be sold to. So if I'm a tech guy, I'm most likely not loving being sold to. So now the way that I sell my business, my product, my service is in a very passive way, right? I don't want to bug you, Hayk. I'm not the type that bugs, but then I can't get in front of you to sell my product and my company dies. What's the balance there? And what kind of startups do you prefer? What kind of founders do you prefer?
Look, this is a excellent question because this is exactly...
I only ask excellent questions. Hayk.
Yeah, absolutely. Look.
Just kidding.
And it's hard. You got to have both, right? If you see someone who's brilliant in tech, not so good in business development, and you got to add a business development person to the team. And that's why, you see co-founders, 2, 3, 4 people. And this is probably key to success. One of the keys initially when you put together the team, how you allocate the roles between those different, founders in a company and how you incentivize them to work hard towards this common goal. And look, if you meet someone who's a brilliant scientist, a visionary, and a brilliant entrepreneur, you're good. That's it. If nothing crazy happens in their life, if they continue consistently to work, they gather the right people around them in terms of investments, investors, advisors, and employees, the chances are really high they will succeed. But if it's a really good tech person, you're going to have a business development guy. You have to have the visionary. So all these things are necessary for a startup to succeed. It's very rare when one person possesses all these qualities, but if they do, then, it's a completely different story.
Very rare does one person have all of those things.
Yeah.
Because typically visionaries are brilliant and they're charming and they're able to gather people around them and motivate them, excite them, and build a vision. The challenge is they're usually not great operators, right? And so they need almost the right-hand person to run the business, do the boring stuff, that creating systems and processes and procedures and things like that. And then sometimes they're the best salesperson, sometimes they're not. Sometimes you need a product person to really, really make sure that the product's improving all the time. But to me, my biggest thing is I rather have a product that sells, that's good enough, that can be improved, rather than a great product that nobody wants to buy. And that's, I think, product, right? I mean, it happens often.
Yeah.
It happens often, and it really is about that. Very cool. Let's talk a little bit about down rounds. Why are they happening? You mentioned 15, 20%. That's 1 out of 5 to 6 companies who have to raise or are raising on a lower valuation. How does that affect the early investors who took the biggest biggest risk and took on valuation caps of 5, 10 million, and now the company's not worth that? How does that affect the morale of the team and the investors that back these early stage startups?
You essentially answered the question by asking it, because those are the exact things, right? Number one, why is this happening in the first place, right? It's happening most likely because of one of two things. Either when we were making the investment 2 years ago, we focused on wrong assumptions, right? We thought that the company is going to succeed, is going to go up like this. It's like this. It's like, there's volatility. Maybe it's outside, maybe it's inside, unique to the company, probably a combination of these things, right? So that's just making wrong assumptions when you make the investment. Or maybe we made the right assumptions, completely, great assumptions, but then the company did not perform. Both are bad. None of them are exciting, right? And now you have to think, okay, we're not profitable yet. We got to raise funding. Let's try to raise a bridge round. Bridge round meaning a smaller round, a convertible note with 2 years, runway to be able to raise a larger round in 2 years from now. And those are good alternatives because the bridge rounds are on the rise too. But then again, it's not guaranteed you can do that. And then the next is doing a down round or a flat round, meaning that you sell shares in your company today at the same price or the lower price than you sold it 2 years ago, right? And the situation in this case is very strange inside the team because, startups are very growth-oriented organizations. You bring people in saying you have stock options, their price is going to go up, you're going to make a lot of money, continue working hard, and clearly that's not happening. So there is a problem with the team itself, how you keep them motivated to continue working hard to make this a success. And then you have an issue with the investors too, because the existing investors, right? All of a sudden now the new guys are coming in and they're buying shares at a lower price. Basically, you took my money to make money for me. Basically, I bought something for $1. You took $1 million from me, and now supposedly I can sell it for $2. But next thing you know, it's going to be sold for 70 cents, right? That's pretty insane. You take my money and then you punish me by doing a down round. And that's why a lot of times, not in safes or convertible notes, but if you hold preferred stock at Series C, Series A, Series B stages, you will have an anti-dilution protection. Basically, meaning that if there's a down round, there needs to be some adjustments made to the transaction to make sure that the earlier investors get the same value as they would otherwise if this was a up round versus a down round. So there are some contractual protections for our earlier investors.
The deals that we did together, did we have that in our contracts? I'm very, very curious.
Yeah, we didn't because we did them via safe notes. Not safe notes, they're not notes. Safe agreements. And in a safe agreement, we don't have anti-dilution protection. You get an anti-dilution protection at the institutional round, at a price round, when the company is selling preferred stock in exchange for cash. We didn't get there yet, and because of that, we don't possess that protection. But look, and it doesn't mean that the founders are not going to try to renegotiate these protections. Because again, if you do this too aggressively, as an investor, you're like, I have my anti-dilution protection. I need to get it. That's my position. I have my own investors in my fund. They're not going to accept this. This is not great for me. I'm not going to be able to raise my fund 2 or fund 3 if this happens. If you focus too much on your own interests, then again, the founders will get diluted too much, and that can affect their own motivation to continue with the project, right? So at that time, a lot of investors could be like, why don't you just close the project and return the money?
Nice. Hayk, tell me about Ryman Law.
Ramon Law.
Ramon, tell me about that.
So yeah, that's the transition that I'm in now. Essentially, as an attorney, right? You have your own practice. At a certain point, you hit this glass ceiling when you're trying to become a better professional and become a better advisor, more effective advisor for your clients. And for that, you need resources, right? And how you do that? You either join another firm or you continue growing your firm, which is not the easiest thing. And finding the right firm is hard too, because it's not just about the resources, it's also about the cultural fit, right? Is the firm going to restrict you or empower you to become a better version of yourself and to become a better attorney for your clients? So recently, I signed my agreement with Ramon Law. We're joining Ramon Law. Yeah, I'm joining Ramon Law as a partner. And this is super exciting because this firm is very client-centric, attorney-centric, and forward-looking, in a meaning that they don't restrict your ability to determine the economic terms of working with your clients, right? There are no hourly requirements that would limit you in terms of giving you wrong incentives to bill your clients, or no other restrictions that would make you a worse advisor for your clients. So essentially empowering your attorneys to become better attorneys for their clients, and that helps the clients. And then, of course, it has to be a right synergy between the firm, the attorney, and the clients. And I think I was able to achieve that synergy. And of course, the Ramon attorneys are great, and I'm really excited. Man. Yeah, thank you, brother.
That's what Nicholas must have been asking about. Ramon Law. I was like, is there some law that I should know about investing? But now we know. It's a law firm I should be aware of.
Yeah. Yeah.
Very cool. Maybe you guys will help us if 5-6 years down the line we want to exit. I mean, we're actually kind of more interested in acquiring companies along the way. I mean, I prefer to do things internally and innovate and create more value internally. But if we can't, potentially we'd be interested in acquiring other companies to bolt onto higher clout. Awesome, man. Last question for you. Well, actually, the second to last question, but this last one I'm going to surprise you with. And I know you hate surprises. That's why I do it.
You know me too well.
Oh man, but you know me too well. What's the #1 rule for business that you live by?
For me, because I'm in a very interesting industry, right? Practice of law. For me, it's accuracy, right? You got to make sure that whatever your service is, whatever you provide to your client, is accurate, not in terms of the law itself, but also accurate in terms of their actual needs. So if a client is going to pay you a lot of money to help them with a certain transaction or matter, you got to make sure it's not just accurate in terms of the actual law or the legal procedures and processes, but also the business outcomes for your clients. So accuracy in my field would be #1, and of course, loyalty to your clients, because a lot of times when you work with tech companies, even with venture capital funds, right? You don't see the outcome too early on. So psychologically, it's hard to continue helping when you don't see results, even with funds, right? Because you think they have a lot of money, they make investments, but they don't really see the results until 5 to 10 years from after they make the investment. So you have to bear with them, and you have to be mindful of their own situation. So being loyal, being accurate in your advice, and basically putting their interest ahead of your own interest at times is absolutely necessary, because that's how you serve, that's how you help people grow. And as an attorney, you grow when your clients grow, right? You have 2 assets. It's your reputation and your clients. If you help them grow, you will grow with them. If it's the vice versa, you just bill, and don't show real value, then, it's going to be hard to...
You'll be replaced very, very soon with a button, right? All right, Hayk, I'm going to keep you, I'm going to end it with keeping you on your feet. All right, and I literally just thought of this. What is one thing you like about me? And what's one thing that drives you crazy about me?
So it's very obvious. It's your energy, it's your drive that I love about you. The way in every single conversation you find a way to spark this light in the person you talk to, right? You have these ideas, you have this unique way of motivating, incentivizing folks to do things that you don't even think about, right? You talk to someone, they don't even know that exists. You tell them about it. The way you tell them about that certain thing is you can tell they basically see it the same way as you do. And I think that's $1 billion skill to have, how to motivate people, how to incentivize people to think bigger and to focus on important things. So that's
awesome, man.
Yeah, no,
thank you.
Of course it is. And that's one thing I love about you. And that's one thing I always tell my friends and your friends about you. And most of them know it about you, but it's always good to remind us about the great things about you. And the one thing I hate about you, man, let me see. This is hard. How I say this sounds true, but not too offensive.
Dude, go at it, man. I'm not easily offended. You know me.
This is a tough one. One thing
we have too good of a relationship. Don't worry,
one thing I don't like about you.
What drives you crazy?
Nothing drives me crazy about you other than the good things.
What confuses you?
What confuses
you about me?
I feel like sometimes you can be a little too optimistic about certain things.
I knew you were going to say that. You knew it.
But then the good thing is that you're easily convinced that, maybe we should take this a little slower. But your optimism is great motivation. But at the same time, sometimes I feel like because we have the relationship, I can tell you, although maybe we should just take this slower and take a break and look into this and maybe ask other people for their feedback before we make the final decision.
I actually need that. I need that. That's actually something I need. In fact, at work, I have my goons, they call themselves. They're lady goons, Brenda, Melanie, Jackie, and they protect me from me. And so I will take on things that actually is really cool, and then they'll stop themselves. You can't do that. I'm like, why not? They're like, you can't. Have you seen your calendar? So I'm really, really big on, especially for someone like you, who's an attorney, who's all about accuracy. I think you pride yourself on data and facts versus enthusiasm. Unfortunately, knowing me, I'll probably still do that deal that we talked about. And I have a good feeling about them.
You should.
But yeah, 90% of the time, this optimism drives a lot of great success, and 10% of the time it holds me back, and it's a recurring theme. So I really appreciate that, Hayk. Thank you so much for your for a beautiful compliment and a very accurate feedback, and I love that. And so
my pleasure.
Appreciate you, Hayk. Any questions you have, man? Like, this has been so fun, and hopefully it wasn't as nerve-wracking as you thought.
No, this is great, and I really look forward to doing this again with you. When you're ready, I'm always ready to talk and share the new things I see in the markets and see how we can all become better as a group, as a community, as just a society, just a global community, basically. Yeah.
Heck yeah. We should next time talk about how AI is potentially disrupting your industry and what you would do, a people-centric firm, a people-centric person like you would do to combat that. But we're going to leave that as a teaser for next time.
Let's do it.
Dude, you've been awesome to talk to. I promised it would be a conversation, and I hope that's what it was. That's what we do here on Tech Leaders Playbook. For me, I'm just really interested in this world, and I know you're a very credible source. That's why I was excited to have you on. Thank you, Hayk. You didn't let us down.
Thank you. Of course.
Good luck on your awesome new career. They're lucky to have you, and you're going to kill it. So I'd like to know more offline.
Thank you. And this was a pleasure for me too. And likewise, I enjoyed this and look forward to the next session.
Thanks for tuning in. If you enjoyed that episode, you're going to love next week's with the assistant coach of the Detroit Pistons, Hayk Mamajanyan. Rex dives into the aspects of leadership that make people trust you to make big decisions and the traits that enable you to make a culture that motivates. Subscribe so you're notified and don't miss it. See you then.